For more than a century, the world treated us debt as the safest asset on earth. That changed this week. Moody's has officially downgraded the United States. Not a collapse, not a crisis overnight, but a historic signal. For the first time in modern financial history, none of the three major rating agencies considers US government debt truly AAA. S&P cut America in 2011. Fitch followed in 2023. Moody's held the line longer than anyone else until now, and markets noticed immediately. Bond yields surged, stocks sold off, the dollar weakened, the 30-year Treasury yield climbed above 5%, one of the highest levels seen this year. That matters because Treasury yields are not just numbers on a screen. They influence asterisk mortgage rates, asterisk corporate borrowing costs, asterisk credit markets, asterisk stock valuations, asterisk global capital flows. In other words, the price of money. And the price of money is rising. Why did Moody's act now? Because America's debt trajectory is becoming harder to ignore. Federal debt is projected to rise toward 134% of GDP within the next decade. Annual deficits remain massive, and interest payments themselves are becoming one of the fastest growing expenses in the federal budget. That creates a dangerous feedback loop. More debt, disordained higher interest costs, larger deficits, even more borrowing. The Congressional Budget Office has already warned about the long-term math. At the same time, Washington continues debating additional tax cuts and spending packages worth trillions. The market is beginning to ask a difficult question. Can the world's reserve currency continue operating on permanently expanding debt forever? This downgrade did not surprise serious investors. Many expected it eventually. But there is a difference between understanding a risk intellectually and living through the market consequences when sentiment shifts. That is where we are now.
Because confidence, not just economics, sits at the center of every financial system. Since the dollar left the gold standard in 1971, the global monetary system has depended increasingly on expansionary debt, liquidity creation, and central bank intervention. For decades, that system powered extraordinary growth in financial assets, but it also created structural dependence on cheap money. Now the world faces a new reality: asterisk higher debt, asterisk higher rates, asterisk geopolitical fragmentation, asterisk rising fiscal pressure, asterisk and enormous AI-driven capital demands. This is not simply a US story. It is a global monetary transition. The biggest risk is not necessarily an immediate collapse. The bigger risk is slow erosion.
Asterisk currency debasement, asterisk persistent inflation, asterisk weakening purchasing power, asterisk rising inequality between asset owners and wage earners. Because throughout history, real assets tend to outperform during periods of monetary instability.
And that is why today's downgrade matters far beyond Wall Street. It may become remembered as another signal that the financial system is entering a very different era. Subscribe to @Ana Armstrong for institutional level market analysis and explore the future of AI-powered financial intelligence at chataimi.ai.